analysis on Kimberly-Clark. The methodology examines three numbers that most Dividend King analysis never touch: dividend payout on a dual basis, DCF intrinsic versus market value, net debt leverage. Kimberly-Clark has a 53-year record of paying and increasing dividends and 92 consecutive years of paying a dividend, which places it firmly in the Dividend King category. There are 6 other firms that rival Kimberly-Clark's record. If they look any further, the question about yield comes next. Most investors follow their broker's recommendations and stop the analysis right there. Do yourself a favor and invest 60 seconds. Methodology will surface 3 numbers that say something a bit more complicated. King status is awesome, but not sufficient. The cash will tell you the rest of the story. Our methodology goes beyond conventional analysis. The 10K has a wrinkle that most don't pay attention to. Kimberly-Clark is mid-separation of part of its business. The income statement and the cash flow statement are temporarily on different bases. That's not a flaw, it's by design. Number 1, the dividend payout. And here it splits. On operating cash, the dividend takes 60 cents of every dollar. That's a safe, well under 70-cent Staples threshold. On free cash flow, the dividend took 101 cents of every dollar in fiscal year 2025. It exceeded free cash flow slightly. That sounds like dividend stress. It's not. CapEx jumped 58% in 1 year. That's an investment cycle, not a signal of deterioration. The 3-year average is around 74%. So this year is the outlier. But number 2, the DCF intrinsic value. The methodology lands in a range of $70 to $86 base case. Even pushing the assumptions, the methodology gets to 108. The market is at 103. So the math says the stock is priced 20 to 40 cents above what the cash flow supports. Honest read, the market is paying a premium for a 50-year dividend safety, not for cash flow growth. Number 3, net debt to EBITDA, 2.05 times. Under 3 is a stable comfort zone. KMB sits well below. Interest coverage is 9 times over. The dividend isn't leverage threatened, so when fiscal year 2025's free cash flow squeeze happened, the balance sheet absorbed it cleanly, not a safety alarm. One thing the methodology surfaces that the headline numbers don't. Kimberly-Clark is mid-separation of its international family care business. The income statement is restated to continuing operations. Revenue reads $16.4 billion. Cash flow statement is still total company, including the part being separated, which means the dividend coverage math mixes bases. We handled it both ways and put the numbers on the screen. The methodology doesn't hide the wrinkle. The wrinkle is the content. Those 3 numbers don't say buy, they don't say sell. They say the dividend is safe on the cash. The stock is priced for safety. The leverage absorbs the wrinkle. The market is paying a premium for a 53-year track record. Methodology is paying attention to what next year's cash actually does. Follow the cash, not the noise. So I don't hold Kimberly-Clark. You can see the full forensic methodology cycle on Apple, AMD, and others on Occam's Forensic Jury channel. Link is in the description. Drop the next Dividend King that you'd like the methodology applied to. The editorial calendar lives with the audience. Thank you for taking the time to watch this video.